And joining me on the podcast right now and on video, by the way, you can see us on YouTube. And if you want the next one to your inbox, hit the subscribe button and notification bell. Is Paul Hill, equity analyst, full-time investor. You all right, fella?
Yeah, morning, Justin. We may be on Sky, later on if we're on video.
Yeah, well, do you know what I find odd? I've been talking about this, the markets. I see choppiness happening, because what we've got, and I described this before, as a Titanic gap. And that's the gap between the vaccines, the rescue boats coming in, and just basically worse data coming out, infections growing. In America now, there's a lot more restrictions happening. In this country, we're coming out of, well, today we're going to find out apparently that, what restrictions areas are going into. So we're going to have a lot of bad data, I think, over the next month or so before we see any effect from the vaccines, So it's almost like you've got to hold your nerve here, or either top up if there's opportunities. It's going to be a bit volatile for the next month. So I think we have a Santa rally, though,
Oh yeah, and also I think we have had probably a large part of the Santa rally already. I mean, if you look at an index that small cap investors should really concentrate on is not AIM. AIM is sort of like disjointed because it's top heavy with the likes of Boohoo and Asos, and I think Chai Med, which is a big medical business out in China. So have a look at the index to look at for small caps against your benchmark is the SMXX, which is all small cap companies, excluding investment firms. And that has actually moonshotted about 20% since the first good Pfizer vaccine news, over the 20%. And what's happened is that it's lifted all boats, but some boats deserve to be lifted and others don't. And that is where the stock picking expertise needs to come in.
Yeah, but you know what I would say, though? I got really too caught up in the macro, at the start of the year. Well, like others, I missed the aggressive bounce because I just thought, no way is the market going to bounce. And it did, like, phenomenally. And I suppose when everyone tries to predict the market, it does the opposite thing. And I think what I've learned from that is focus on your own stocks, focus on the own sectors you're in. Don't worry about indices and indexes, unless you buy funds, I suppose. But and as soon as I started doing that and stopped focusing on the macro numbers, it's good to have a top level view of that and where you see things and certain trends happening and all that. But don't get too worried about that because we know it'll play out fine. If you've got a company that's fundamentals are going to improve over the next 12 months, 2-3 years maybe, that's where you should focus on. Just keep researching the companies you're in or more companies and not too much because you can't do anything about the macro anyway. You can't do anything about it.
Yeah, well, but turn the clock back sort of 7 or 8 months, yeah. And what was the trigger for the huge rally? It was the Fed, the Bank of England, and the ECB stepping up to the plate and deciding they're going to do unprecedented levels of fiscal and monetary stimulus, and nobody had ever seen that at all ever in history. And that was what was causing the fear. The bond market went just into sort of like totally frozen. Nothing was moving whatsoever, and it was that central bank action that actually de-blocked all of the bond market that then allowed the equities to rally. So I don't think you've got to concentrate on the top level macro, but that was the trigger for the actual stock market rally. There was fundamental change in monetary policy and fiscal policy that boosted stocks and bonds. Everything went up. So it isn't just looking at the macro, it's actually looking at what the triggers were. And most investors at the time...
Most investors will never look. You are a deep analyst, right? You look at the deep stuff. And most investors, they don't do it full time. They haven't got time to do that. And I think it comes out of this. It's as simple as this. When people are really scared, you buy. That's it. And that's what Warren Buffett said. When there's blood in the streets, you buy a little bit. And, if you had a time horizon is 2, 3, 4, 5, 6 years, 10 years, you buy. If you're a trader, of course, you've got to sell and all that stuff. But trading is hard. I wouldn't do that. As an investor, keep it simple. And I realize that when that gauge, that fear and greed index, that was at 2. I've never seen that before. It was at 2. Like, it one lower than that. That's all. And they said when it's down that level, no one else is selling. Everyone has pretty much sold because they're all scared. That's the time you just pick up stock, And any stock you could have bought in that sell-off would have been doubled by now. And the good ones have done a lot more than that, So I just think keep it simple. Buy one.
Yeah, I mean, the thing is, you can take that approach. However, you've got to understand what is actually triggering it. Okay, and
you don't at all.
No, you have.
You can't control it.
Okay, I'll just give you an example, Justin. Yeah, you've got a whole bunch of stocks. You put them into relevant buckets, stuff that wouldn't get over the COVID void if basically without central bank support at all, and those will. And if you concentrate on the stocks that can get over on their own, momentum, then yes, you've got no problem. But let's just say most people have a portfolio of, say, I don't know, 10, 15, 20 stocks. And let's push the clock back to where it was at the beginning of March or mid-March, and you've got 4 or 5 of those which would definitely will go bust if it doesn't get central bank support. What do you do? Yeah, and you basically, what you're saying is that regardless, you buy. Yeah, and that would have been the right call. Okay, only if you'd betted on hope that the central bank was going to basically push the sell button, push basically the monetary button. And you were basically you were betting on somebody else doing something else to get those companies that would go bankrupt over the void. Unless that played out perfectly, but it doesn't always happen.
No, but the thing is, that's always going to happen because you've got a bad scenario and a worst case scenario. Now, if you do nothing, you're going to head for the worst case scenario. You're going to have millions of people unemployed for years and years and years. It's like right now, the government, like Rishi Sunak, doing the spending plan and being very generous. But essentially, the government are an investor in the economy. They get taxes, off people. That's how they exist. And even good times, going to the deficit. So, I thought myself, how can the government make money off this and invest in business? Well, they sort of are. They are, because it's tax receipts they get from that. Now, if everyone's business goes through and they'll support them, they'll not get any tax receipts for years and years, or will be massively down. Now, if they support all the businesses and get them back on their feet for the next 12 months, the tax receipts will go back up. So they have to do that. So there's a bad scenario and a worst case scenario. The bad scenario is pumping loads of money in and hopefully get the economy back up. The worst scenario is doing nothing. Now, what are you going to do? So you've got to go one of two ways. You've got to really pump the money into it to get the economy back on its feet, or ignore it, and you'll have like 10 years of literally, sort of like the 1930s. So that's what you have to do. So of course, there's certain businesses you shouldn't go into anyway. But let's be honest. I think there are businesses like, for example, Cineworld. Let's give an example of that I wouldn't invest in beforehand anyway. I just think it's only going to be a massive growth. They had big debt. They're buying up. It's not an attractive proposition anyway, Cineworld. So when you get companies like that in trouble, that could have been in trouble in 5 years' time anyway. Yeah,
I mean, the rationale you've just described, is using fundamentals, which is exactly the right approach. So we're on the same page. The point I was trying to actually, make was if you just base it on the relative sentiment index, the RSIs, which is you're saying the fear index. Yes, it's a good indicator of when to buy, but you've got to back it up with the view that you bet on the central banks providing the support, which is actually the correct way of doing it, not just saying, oh, everybody's selling, so I'm going to buy. You've got to have a basic.
The genius is in simplicity. As humans, we inherently want to make things more complicated. If you look at investing, you see why so many people don't get involved in investing. There's every metric under the sun. You can look on websites, you can get these sort of silly metrics of, EBITDA times something, extrapolated, real terms, and it just puts people off. And it essentially comes down to, look at this business. Is it a business you like? Are you excited by it? Is it growing? Is it doing well? And, and then try and validate. But you know what? I've gone into stocks and I've analysed stocks sometimes at a silly level, really dug down into everything. And I'm going beyond the assets and all that stuff. And in the end, it doesn't matter. I've seen stocks 10 bag that you would never think 10 bag. And I thought, you know what? I've overanalyzed this. And so the average Joe in the street will never look at the bond markets. Like so you said, the thing to look at is the bond markets. They'll never look at that because it's boring. And I don't understand it myself, pretty much. So I just want to invest in a company that can go to the moon. That's what I want to do. And do you know what? I think the more we try and keep it simple, the better we'll do. And I've overcomplicated it. Whenever I've overcomplicated investments, I've always come off worse, pretty much, because you know what, sometimes it's gut level and you like a company, think this is very popular because you see it's popular, and you look at the most basics of all. Look at revenue growth. Don't worry too much about profit growth at the start. If you have big revenue growth in a company, top line figures always there, one of the first things they'll show is revenue growth. That's a good sign. And then you can go down in margins if you want that, or the margins and all that stuff. But that again is complicating it. I think if anything, as humans, Google, right? They killed it with their search engine. Do you know why? Because everyone else was filling up their front page with links, pictures, this to that, finance here, entertainment here. Google came along with a search box and hit the search button. They won. You know what? They kept it simple. And if we can do that as investors, keep it simple, well, we'll do a lot better. We overcomplicate it, and we don't even know we're doing it. We try and add it. The more we learn, the more we complicate things, the more we make it harder for ourselves. I think.
Yeah, I mean, I'm absolutely on the same page. Keeping it simple makes, a good and clear investment.
No, but you're an analyst. You love digging deep into things, and you know what? It does you well. But sometimes, how many times have you been put off by an investment on a minor issue, which you see as a minor issue now, but at the time you thought that's quite important, and then you look back and the stock price has gone up like 3 or 4 times, and you think, oh, maybe that wasn't such a big deal, because everyone else doesn't look that deeply, And so, okay, because I've been worried about investments, and I thought, why did I even worry about that? Most of the mistakes I made is that a stock has rallied and it's rallied, and oh, it's overvalued. Do you know what? Don't worry too much about valuations. There are always plenty of private investors that will pay more for a stock than you will. Always, pretty much. So, I mean, obviously you can get to a certain extreme, but I mean, you can be really, tinker on the edges on things that aren't important. I think sometimes, and I just think it's hard for every human. We're all trying to complicate things to try and keep it simple. I mean,
Yeah, I think just the last bit on this. I mean, all I would say is that equally, don't just buy if things have gone down, because the definition, a definition of a stock that is 95% down, is a stock that was 90% down and halved. So you can lose a lot of money by basically buying dog stocks, and they're basically continued falling traps. And so you've got to have a reason, and your simple approach is keeping it basically clear, concise, and to the salient facts makes a lot of sense. But have a thesis rather than just a hunch.
Yeah, no. I've got a thesis. I've got a 9-point plan that I go through pretty much every time I look at a stock, but the basis of that pretty much is scalability, and growth, and also it's valuation, and that's then underpinned by price pretty much. But I've seen people confuse, a market capitalization with price. I've seen people on Twitter saying the share price is going down. This is cheap. Just because the share price has gone down doesn't make it cheap.
Exactly.
I mean, you have to sort of relatively know. When I ever look at a stock, I do try and work out, okay, if they're earning this much, what's the multiple? Is that cheap or expensive, or what? Or how big can they scale this? That kind of thing, But I've got to be excited by business as well, because we are buying businesses at the end of the day. And sometimes I just get excited. I buying a business on the metrics alone, and the business bores me. I think, I'm not really into this business, and I sell, So anyway, let's look at specific news. Any company news out? By the way, I want to talk about SourceBio, because I was talking on the podcast with Vadim Alexander, head of healthcare at SP Angel, and we talked about COVID testing stocks. And I just said something, a bit silly, controversial. I said, COVID testing won't be here by Easter. It'll be done, all gone, pretty much. I said, it'll be, with hype around that has gone. And Vadim argued with me, he said, no, it'll take a lot longer. I said, if we get 3 at the moment, vaccines out. But if we get, I don't know how many of the big guys are out there, about 5 or 6 good vaccines in the Western world that work. So if they work, big if they, and if we distribute them properly and as quickly as they say we can, and the mass of the population are vaccinated by before summer, why do we need vaccines if they're working? If there is effective
testing, you mean why do you need COVID testing?
Why do you need testing? Sorry, and of course, SourceBio, their figures are amazing on this. I didn't realize this, and we were talking about companies. And the difference is as well. I said, no, I'm talking about companies. If you're invested in a company who hasn't got a commercial testing kit out there already doing the business, it's a bit worrying because the window is closing. The opportunity now, SourceBio is killing it already. So is Novocyte. So those two, and also they've got other things. I mean, SourceBio's got lots of other legs of business, and that's not. But so okay,
just to answer that question, Justin, very good question. Okay, we had the CEO of Qantas Airlines came and made a statement. I think it was on Monday. So this is a pretty heavy hitter, okay, in the transport and leisure industry. He said he will insist. And this is basically a worldwide airline. He will insist every international passenger next year has to basically have immunity, to COVID. Has got to basically either be vaccinated. Now, if you've been vaccinated, you will also need to have an antibody test, okay? Because that will tell you whether your vaccination has worked. You've got sufficient antibodies to travel. So when it comes back to antibody testing, i.e., are you immune? You will need it if you ever want to go on holiday on an international travel with Qantas, and you can guarantee that the IATA, which is the international travel, will adopt that policy, across the patch. Yeah. So yes, there will be antibody tests. Now, when it comes to antigen testing, in terms of have you actually got the COVID disease, then you're going to get it again in such that you're perhaps not as much. But if people want to basically go into homes, etc., you might well find that, people or go into areas that have got sort of COVID testing, you might well find that you need to basically be clear that you haven't actually got COVID. So, yeah, I still think you will definitely need COVID testing. Antibody will definitely be required, and antigen will probably be required as well. It won't be as much as it is at the moment, because we just don't need to test every single person in the population. But it'll still be ongoing, particularly for specific instances where you have contact locations. An antibody will definitely happen, and an antigen will be less than it is currently.
Yeah. I think it'll still be around. What I'm saying is, if these vaccines are distributed by, Matt Hancock, I don't have much respect for anyway, said we'll be back to normal by Easter. Now he's trying to big that up and get that plan ahead, and he's failed on many times before. But let's say we are back to normal by Easter, and let's say 60% of the population are vaccinated, and those tests will be coming back, pretty much negative a lot. The policy is always up for change. That guy from Qantas, whatever, or the airlines will say, well, you don't want to keep testing people because most people are vaccinated now, and we are not getting any much, occurrence or infection rates are not very high. So it's a waste of money for us or them. So they will change that policy, because if vaccinations work and they're that effective and they're that distributed, they won't need them.
Yeah, but if the worldwide airline body says that
they'll change it. I mean, people will go back to flying very quickly. Behavioural change. You see it in the stock market. The stock market can go from being most bearish one day to most bullish the next day. People's sentiment changes overnight, and even though when you're so entrenched you think it can't, it does. And I've seen it so much. We've been in. Sometimes I feel really bearish, and the next day I feel bullish. And that's the way behaviors change very quickly in that respect.
And then the other thing, you can actually repurpose a lot of this, equipment and testing to do other infectious diseases. Because I think it's been a disaster, obviously, this year in terms of human life and tragedy, but actually it's fundamentally improved certain areas. I mean, for instance, medical science has proved that rather than 5 to 10 years to develop a vaccine, they can do it in 10 months. And that's using technology like, mRNA, which is the Moderna and the, basically the Pfizer stuff and the BioNTech. Now, that can be utilized in lots and lots of different areas. So effectively, when it comes to sort of the testing, immunodiagnostics, you could find that actually a lot of this testing capability can be repurposed and used in leading edge sciences. So I don't. What I'm saying is it ain't going to be scrapped. And
no, it's not. But my focus, pretty much, maybe I didn't articulate it very well, was that be careful if you're investing in a company whose main focus is COVID testing and they haven't got a commercial product already selling. Because, like I said, when I invest in a company, I want to know, is it improving over 12 months, 3 years, 5 years? I don't want to know, will it be around in 12 months if I'm lucky? That's not the way. But if you're a company that's one out, like SourceBio, for example, that's just one part of their business, isn't it? Maybe you know more about them than me. But lots of other parts. And at the moment, that part of the business is booming. But they've got other parts of the business, So that.
Well, I mean, just to give you an indication with SourceBio, I mean, their biggest shareholder, Chris Mills, who's one of the smartest in small cap and medium cap, has been buying shares on the market. He already has 29%, so he believes in the story. And one of the reasons they could really benefit next year is that I understand they are negotiating with all the big vaccine makers to be able to store the vaccines next year ahead of the sort of like the autumn and the winter season, whether it's the mRNA vaccines that need to be frozen, or equally whether it's the AstraZeneca, which can be put into chills, because they have basically healthcare grade storage, chillers and freezers in Ireland, the UK and the US, just where these vaccines are being made. So they could actually just make, hand over fist from that division next year, just on the vaccine.
That's clever, though. That's clever, because they are along the chain there. They're really at the start of the chain, the testing chain, the vaccine part of the chain. They've got that as well. So that's very clever. They've got other parts of the business.
And the other thing that they just announced in the trading update, they just won a big cancer screening framework contract with the NHS. And we've got millions and millions of people who haven't been able to have elective surgery. So you've got that. And yesterday, Rishi Sunak already announced £4 billion to try and get over that hump of the backlog of elective surgeries and stuff. So they're in a lovely sweet spot. The base business is going to do well over the next 5 years, which more than underpins the share price. And anything more they get on the antigen PCR testing is just perfect jam. It's just basically icing on the cake. And we're still going to need antigen testing into early next year, no doubt about it. And that's what the NHS that's why it is booming, because we still need it. So that's all optionality to me. So SourceBio. One thing on the other side of the flip side, I know you and I have discussed quite a lot GSK, and I've liked Glaxo, okay, because it's cheap. And I think, and when I compare it to Astra, but actually what's really sort of come to light, and it's sort of like now I understand why the shares are in the doghouse, is that because it's got a big vaccine division, it's all old science. You compare it to the mRNA, the mRNA science that has just been developed. It just means that, the efficiency rates of their old vaccine technologies sort of like 50 to 60, 70%. Now this new technology does 90, 95%. That's why the shares have performed so badly, is that actually they are, even though they're the world's biggest vaccine maker, they are a long way behind in technology terms, and they're going to really struggle in 5 years' time. So I can absolutely now understand why investors saw the weakness in the business model. And it's a shame, because I think they're a great company, and they do look cheap, but I think that's cheap for a reason, because future cash flows are going to be hit badly because of new technology that's come out of the COVID world.
Yeah. Do you know what? Talking about that, the vaccines, it is interesting actually, because if you look at it, even though the efficacy rate, we don't really know with AstraZeneca at the moment which one it is. It's really odd. The half dose and the full dose, a month between, works better than they said. Give the system a boost to start. Works better than the full dose. But if the efficacy rate is still like 70%, which is amazing, better than the seasonal flu anyway, generally, that's 40 to 60%. That is the one that's the game changer, isn't it? Because like I said, they don't need to have all this extra cold supply chain, so I mean, and of course, AstraZeneca is going to produce a couple of billion or three doses, 2.5 billion or 3 billion doses. So that's the real game changer. It's cheaper, and of course, don't need that cold supply chain, which is a thing. But it'd be interesting to see. I think honestly, next week or the week after, we'll have regulatory, passes from the FDA, approvals, and it'll help the market again. But again, we're going to get this choppiness. We'll have bad figures, more infections. America's infections are going through the roof. It's nuts. And of course, wherever their market goes, ours tends to follow a little bit. In fact, ours follows down, doesn't tend to follow up. It's like underperforms very well. It doesn't overperform at all. But
all I would, again, it comes back to the first point you made. Buy stocks, not indices. Okay, and certainly we've had such a hard rally in those epicenter stocks. When we've talked about Tom Lee out in Fundstrap, and he's been recommending that we just buy anything that looks remotely beaten down and recovery stocks across all, and that's what's happened. But certain stocks justify it and others don't. So for instance, ones which don't would be the hotel stocks. They are back to their 2020 highs at the start of the year, and they're closed. They've been closed, the hotels are, but the stocks are saying they're back and they're going to be able to trade, even though they've taken on a shed load of debt. So I wouldn't be going anywhere near those. I wouldn't be going anywhere near the airlines either. City World, which you pointed out, again, I prefer other spaces. But a stock that I have bought, as in earlier, and are very happy to hold, is one which came out, is insurer Aviva, which came out with Q3 results this morning. Now, they have just reinstated their dividend, their full-year dividend, at 21p. The shares are at £3.25, gives you a dividend yield of about 6.5%. Now, how do you value a business like, basically Aviva? It's just come through the worst, crisis in mankind, with all the potential claims for business interruption and all that sort of stuff. And it's come through relatively unscathed. The balance sheet is fine. And it's going to resume dividends, etc. Now, the way I look at this on a valuation, it's not an exciting business. It's basically something that is going to, it's been massively undervalued. And I would treat it a bit like a utility, okay? Now, I know you don't like terminology, but I would use and this is for investors who are a bit more interested in valuation, a dividend growth model, yeah? And I would assume a cost of equity of about 8%. It's bonds. I know you don't like bonds. It's bonds trade at 4.3%, and it paying a dividend of 6.5%. But the dividends are said to go up about low single digits. So I would say you would value that at about roughly 20 times net tangible, not tangible, net dividends. Yeah, using the dividend growth model. And that would come as a minimum of £4. I know, yeah. A minimum of £4.20.
It's to me, Aviva, I won't invest in it because it's boring. There's nothing, there's no really, and I know Warren Buffett said boring, you've got to invest in boring stocks. No, I don't want that. I mean, you don't have to invest in boring stocks at all. You can invest in stocks actually, with stories that you enjoy. Aviva's got no story you can sell to me. Sell me the story. Don't tell me about his, discounted dividend model or net tangible asset value. I don't care.
Okay.
The pants off me. I'm never going to put my money in that because, do you know what? I know the next bit of news that comes out from them. I'm not going to say, wow, that's good, that's exciting. That's why I like small cap stocks with a good story. And,
okay, Justin, I love boring stocks when they can generate 100% return in 12 months. Just give me more boring stocks.
But they don't generally. And do you know what? Exciting stocks generate more than that. Look at my returns of the last, say 3 years even. Even since I've done since 2009, my portfolio's gone up by 4,600% by investing in exciting stocks with good stories that I'm really passionate about. I enjoy, and I look forward to updates. There's no update from Aviva I will ever look forward to. It'll just come out with a load of text about nonsense that I'm not interested in. Bore the sense pants off me. Sell.
You sound like Jim Cramer on CNBC.
Well, Aviva, come on, it's boring. Why should anyone? I mean, unless you're a fund and you're investing for pensions, why? Come on.
The only reason why I like it is it's significantly still undervalued, and just for anybody who has invested alongside me, I value it between a minimum of 420 and a top of about 550, and that's using on a price to book ratio. So it's somewhere about 470. The shares are still 320, 325. Have a lot to run. I've made a lot of money so far on it. I'm very happy to make another 50% on it. And if it bores the pants off anybody, it doesn't bore the pants off me because
I tell you
pretty.
I tell you what's useful. If you suffer with insomnia, get the annual financial report. Get into bed at night. Start reading through that. You'll be nodding off very quickly.
Okay. Well, if you want to go basically more insomnia and even a thicker annual report, read Lloyds is one because their shares have gone from 25p to 36 in about 3 weeks. And again,
this is why the only reason why they're exciting is banks is like they'll take a big hit and it'll sink for a while, and you can chuck a bit of money in, thinking Lloyds is never going to go through. It's fine. You chuck a bit. That's exactly what I did. That's why I made good money out of the financial crisis. I basically chucked all the money I had into Lloyds, and it kept going down. I kept chucking more in to the point where I literally and you know what? Normally I said these companies are boring, but I had so much money in it. I was sweating going to bed at night, waking up worrying about my money. That was the only excitement I got from it. But luckily, I did quite well from it.
You did brilliantly. I mean, I think they went from about sort of 20p to 70p, didn't they? 75p at the top, or something. Yeah. So anyway, I mean, if I could make 50 to 100%.
That's how you make Aviva and Lloyds exciting. You just chuck all your money in it, all of it. Just absolutely just sit there. Right, go on. Buy low, sell high.
Well, and another one which has been extremely boring, but frankly has made me a shed load of money over the last 3 weeks is one of the house builders, Taylor Wimpey. Because that's up 60% in 3 weeks, and frankly, if I had all those three together, I could probably buy your house, mate. So in profit. So I'm pretty sort of bored, but very happy with what they've done. But I believe there's plenty of upside in any of those.
Yeah, no, it probably is. But again, do you know what? Like I said, I keep going back to the point where I'm buying businesses pretty much. I'm buying a share of a little business, and I've got to be quite excited about it and passionate about that business. Otherwise, because you're an investor in a business, that's what it is. And that's why I like small caps, because they've got a story and nothing more powerful than the story. It conquers everything. And a good story, and that's why you say, why have the hotels risen? It's sentiment, the sentiment is based on stories in it, and people saying it's and it's so you can knock away all those metrics, evaluation metrics, and throw them away and say at the end of the day, it's been battered down. And like I said, will you wait now? Always, and I've been saying it for months. I said, listen, now's the time to get into those, quality stock sectors and be knocked down, and just you don't need to do a lot of research. Actually, you just wait, because this time next year the economy will be back open, will be back to normal, but the stock markets are probably be higher on those sectors than they were before they went in, because there'll be so many people buying into them. It'll push them all up. So yeah.
Okay. Here's a question for you then, which is not that boring. It can be boring if you want to look at the big boys, but you guys, I mean, you understand a lot of the sort of the smaller plays. What is happening with oil? Is that a value trap, or is that basically an opportunity? It's now, Brent is trading at $48 per barrel. It's moonshotted from about 35, yeah, and the oil stocks have absolutely rocketed around the world, big cap, small cap. So would you like to sort of throw the dice on a few oil stocks, given the rally, or what would you do with the oil company?
Now, I said in the weekend podcast about a month back, I said, in those sectors, your banking, your hospitality, your leisure, your travel, you can put oil in that as well, because that will rally as well. As soon as the economy opens back up, of course, more people will be using oil, and it's been oversold pretty much. It's a technical bounce, isn't it? But the difference is, when I'm investing now, I'm looking for trends and themes. Themes are getting stronger over the next 3 to 5 years, 10 years. Like something in the work, like for example, I tell you what's a theme I've got. I own Gfinity, for example. That's esports. It's getting bigger and faster every year. Okay, and I know this because my kids, all they want to do is play games. All they watch gamers playing games. That's all they want to do. They don't watch TV, and that's getting big. And you can see the money pouring into it from all the big players. That's a theme that will be round and get more popular as quality of games get better. They get faster. There's more people coming into it. So that's a theme. Now, oil, in my mind, is a theme that's probably with us now for what I'd say. Where's peak oil is not too far away, because they're talking about 30% of the world's cars by 2030 on EV. And it won't get to that before oil starts to really tank, I don't think. But I think it'll rally because, of course, there's been lack of investment going into exploring because everyone's pulling their money out of oil. All big divestments like Norwegian sovereign fund and all that, they won't touch it anymore. So basically, it's not a long-term trend anymore, oil. You will have a technical bounce, and it may go for a while because once demand goes up, or it's still steadily creeping up, I think 2% a year, something ridiculous. But once that tops off, and they're not putting money in the ground to get it out of the ground, of course the price will go nuts. I think for a while. I think the price of oil will go absolutely berserk in a while. But how long will it stay up there for? It's a pop and drop. I think pretty much. That pop and drop may be over 2 or 3 years, but sooner or later we know the theme for oil is not good. It's not good at all, is it?
Well, it's quite interesting actually, because I think we've just had a first. We both agree. I mean, I think at the moment I'm fishing around for explosion.
Yeah.
Can I just add? Yeah, can I just add? Yeah, because I'm absolutely on the same page as you. And now, the whole sort of the oil complex, etc., is being, the decline in it has been accelerated by COVID, and that's one of the beneficiaries. Decarbonisation, renewables, hydrogen power, basically wind, solar, electric vehicles, all that sort of stuff is going to be a massive. The amount of investment going into it is huge, and I would say that whole sector. And I know it's obvious, but has just been. It's like effectively work from home or work from anywhere trend has just been massively accelerated. So that's where I think you, if you want to go into energy, would concentrate your efforts. Is those long-term trends that's going to be here until 2050 if we're ever going to sort of like fully neutralize the carbon footprint of the population.
The biggest trend of all right now, and I don't know any trend bigger than this, okay, is electric vehicles. That is massive. Alternative. That's the biggest. That's the most popular sector of the alternative, to petrol, diesel.
Yeah.
There are hydrogen, and in fact, one of the stocks I held was a hydrogen sort of stock. It went bananas. I was quite an early adopter of it. It went up a little bit. I just got out. I thought it was going to take a long time to commercialise. All of a sudden, it's 5 bagged in the next 2 months after I sold it, which annoyed me. Anyway, I've just bought one share of a company involved in the EV space because there's no bigger trend than that. There's no one policy every government in the world is behind pretty much apart from this. And that is basically they're stopping the selling of petrol and diesel cars 2030, run about there. That is massive. It's every government in the world pretty much apart from North Korea somewhere. But I mean, you don't get bigger than that. So at the moment, I bought one share of a company exposed to this. I'm not going to say because it's too expensive. I don't give any. I wouldn't. I'd be silly to. I'd be silly to tell people to buy up here because it's gone nuts.
You're not telling people to buy. I'd just be interested to know.
No, I'm not saying because I want to, when it comes down.
You're a tease, you are, Justin.
When it comes down, I think it's at a reasonable level. Then I'll talk about it because but as yet, and again, this is a company I got really excited about 6 months ago, and then all of a sudden it doubled overnight. I thought I was a bit slow there, wasn't I? But I was one of these people who was doing research, but I think it'll still come back because they've got a way to go until they commercialise this. They have a plan to commercialise it, but it's in that trend. It's right standing in front of the trend of EV, and I think you've got to have some kind of exposure to that sector because it's one of the biggest trends around. And so I'm very happy the sectors I'm in by missing the EV, which I think is the biggest trend. It's going to be around for a long time, So
well, yeah, just look at Tesla shares. I mean, they've moonshotted, haven't they?
Yeah.
Anything associated with the technology. It's actually what's quite interesting. It isn't so much the cars that investors are getting excited about. It's actually the data that comes off it. All that movement and traffic, and Tesla's so far ahead in terms of data mining and understanding all of that. They reckon it's going to become the next Google because of the data, which is just frankly incredible.
Yeah, exactly. Mark, anything else worth chatting about?
I haven't got any more boring stocks. I'll try and sort of put a bit more spice next week into some of my updates.
No, you've got a decent chunk of money, right? So you can play boring and but for people,
Thank you.
No, but you can, man, and as you make more money, you can play more boring and be less take on less risk and get a lower return because, of course, you've got a decent chunk of money. But the average investor starting out, they need to take on a bit of risk to try and double or triple their money to get enough capital to sort of get to the boring side. But I dabbled with bigger stocks, but I got bored with them, and I thought I've got to be excited about the business I invest in. Otherwise, there's no point me investing in them, really.
Yeah,
so,
well, I mean, I think the point is that you've done really well out of the strategy that you adopt, and it's horses for courses. What you shouldn't do is, as investors, just go for microcaps, not really understanding what it is, get caught by the liquidity trap, they go bust, and effectively you lose. And I've seen it many a time, 50-90% of all your money, your portfolio, because they all go down at the same time. So you've got to have a fair risk tolerance if you want to basically adopt that sort of strategy.
Yeah, no, I'd say if you go over microcaps, look at three things. First of all, is the company funded? If they're pre-revenue or something like that, are they funded until the next value generation point where they'll be existing news driven? Secondly, make sure the share price hasn't spiked up in some way, because if you buy a spike, you can come back down and you can lose 50% overnight. And that's what people do. Companies become more interesting the more the share price goes up with microcap stocks, but that's not when to buy them. That's the opposite of when you buy them. And thirdly, is it sitting on a big trend? Like I say, if it's something that's the trend is basically going down in the next 5 years, all you're going to be doing is if you buy dips, you're buying a downtrend all the time. So if you know that it's going to be that sector is going to get stronger, whatever, over the next 5 years, then you're sort of sitting, riding a wave a little bit. So those three things I'd say look at. Funding, the share price actually makes sure it hasn't spiked, and the trend, the theme,
and also whether it's actually got anything in that theme, because there's a lot of small caps who claim to have a lot of things, but frankly have got no USP. So kick the tires on the company before you actually bet into the theme, because they may not have any real seat at the table for that whole trend.
Yeah, true. I mean, in fact, like EV stock right now, they are sort of pioneers in an area, and I'm asking around, looking at videos and seeing if they are real pioneers, because if they are, it's phenomenal. But I still see them very overpriced, and the potential and the hype has really got the stock. And I want that hot air to come out of it because it's way overvalued. But then again, if everything's EV in a couple of years' time, it's not overvalued. It's like so there we are. You don't know how hot these stocks can get. Like I said, Tesla is a prime example. Anyway, marvelous, Paul. Thanks for that. And,
thanks, Justin. I look forward in hearing what you say with regards to that EV stock.
It's going to be about hopefully 2 or 3 months before it even cools down, because it's But
if you come out with a boring name, I'm going to really have a go at you. Okay.
If you want this next video, by the way, to your inbox, hit that subscribe button and notification bell, which is in the corner there somewhere. Until next week, cheers, Paul.
Yeah, cheers, Justin.